Alright, folks, we have reached one of my favorite topics, range theory. So if you're bored of the previous lesson, which you shouldn't, then you'll enjoy this one. What's a range? A range is one of the two ways the market moves. Trend, range, trend, range. It is how the market makers generate liquidity through interest by accumulation of buy-side and sell-side liquidity. Above old highs, you have buy-side liquidity. Below all lows, you have sell-side liquidity. What this does is the following. You'll see the market chopping between 2 points, range high and range low. What this does is create the interest of selling a breakdown and buying a breakout. It's the way that most schools, even ICT traders, the dumb money pattern trading ICT traders who don't understand power of three, that's how they trade, right? Breakout traders. What usually happens is it'll smack into one side of the range, and usually the first breakout of the range is a fake move. Write that down. What this does is three things. It invites the short sellers. It plants doubt in the breakout buyers. Some of them even flip to short selling. And it stops out whoever bought the rally before the dump in the range low. Right? So it's three parties getting robbed of their money. How? That's how they do it. Range, consolidation, accumulation of buy side and sell side, smack into one end of the range, and then rally to the opposing end of the range. Right. Usually, oftentimes, giving no chance for entries. Right. A range is also the market taking a breath before the next move. So it's a trend, a massive trend, and then it has to chop around, because if the market moved up and down in lines like this, then everyone would make money and no one would lose, right? So they have to get a sharp move, and after the sharp move, those who want to follow the trend, they get chopped up and they continue with the sharp move, right? It's the market mechanics. Also, for the curious eye and the astute pupil, this is a market structure shift, a fake one. Range trading rules, because trading without a system is gambling, right? I don't want to know when to enter. You can find 1,000 ways and methods telling you when to enter. What you should look for is systems that tell you when to not enter, right? When to preserve capital. Because if you have no capital, you can't trade. So rule number 1, preserve capital. In this case, rule number 1 of range trading is buy low and sell high. Buy the range low rejections, sell the range high rejections. Don't buy the range low, don't buy the range high, and don't sell the range low. Right? So when you see a range, you never buy the low. You never sell the low, and you never buy the high. Right? And you try and buy the low or near the low, and you try and sell at the high or a rejection of the high, especially if it's the first move. The target is going to be 2. Number 1 is the 50% of the range, and the target 2 is the opposing end of the range. Always take a partial at the 50% of the range. Always, every single time. And if you focused more on taking trades which went from the opposing end of the range, or one side of the range, to the 50%, then you'll find a lot more trades and you'll have a much higher win rate. Alright, so in summary, buy low, sell high, buy range low, sell range high. Don't buy range high, don't sell range low. target is 50% and then the opposing end. Right? Because the liquidity they got here, they have to distribute it above the high and the old high. They must. Now, here's some eye training. Range high, range low. Never participate in the middle of the range. Do nothing. Right? So, what does the rule say? It says buy the range low and sell the range high, or sell the range high and buy the range low. Never sell the range low, never buy the range high. Let's see what happened. It'll reject the range low, produce an order block, right? This one specific thick down close candle which went into the low. As soon as they close above it, right, that's the candle. You want to buy inside of this range of this candle. And target one is the 50%. Usually, when range trading, then at target one, you'll find some sort of rejection before flipping it and then using the 50% as a level to jump and break out of the range. Right? As a sequence that happens. And that also can be used as a way to validate your range, because in order to avoid ambiguity of the range, see, is the 50% being respected or not? Because that's usually an indicator. Again, you have this, a range high, range low. The market is clearly chopping, right? Between point A and point B. The rules say buy low, sell high. Buy the range low, sell the range high. Don't sell the range low, don't buy the range high. Target one is 50% of the range, and target two is the opposing end. And of course, validation off of the 50% by rejections, smacking into it. This one specific thick down close candle is the candle you're using to buy into to target the 50% and then the opposing end of the range. More on Model 1 in the next chapter. Right? The extremities, if you're a range trader, and range trading is an extremely profitable route to go. I personally know many 6, 7, 8-figure traders who do nothing but range trading. Nothing too advanced. It's price ranges, right? So visibly look for a range low or range high to buy or sell. Right? Look for a range, wait for it to get souped at one end, turtle soup, and buy here, sell here. It's that simple. With, of course, if you want to confirm, with model number 1 being the confirmation. Right? Thick down close candle, let's stab into the low, close above, buy into it. As a range trader, the extremities are your playground. You don't touch price except if it reaches here or here. Everything else is a no trade zone. Next up, we have the types of ranges. We have price ranges and we have time ranges. And this is where the 3-candle model comes in. What do you see? What's happening here is, and this is something I was very reluctant to share to the public, so use it wisely and appreciate it. What happened is this one specific candle is being turtle souped, and according to range trading rules, we target the 50% of the candle and then the 100%. Candles are ranges. Every single candle is a range on every single time frame. Ranges can either be turtle souped or broken out of and retested. Some candles are, by nature, more high probability than others. The market is made through ranges as I've said, to determine the higher time frame bias, which is a big issue in the ICT community, just look if a higher time frame candle has been turtle souped or not, and that will give you the key to the bias. Don't force it. When it's happening, it'll make itself very apparent to you. Range trading rules apply to the candles. So buy low, sell high. Don't buy high, don't sell low, and target 50%. Always take partials. In this case, this one specific candle, if we didn't close below it, then it's a turtle soup. Target the 50% and the rest of it. Within this candle, you have this candle. This one specific candle, and this is a weekly chart, and you should know exactly which one it is. This one specific candle is being turtle souped, and the third candle is going to the target. That's why I call it the three candle model, and a lot more on it in the next chapter. Right, so the 3 candle model. Candle number 1, candle number 2 turtle soup, never closed above, therefore target the 50% of this candle and the opposing end of the range. Right, so candle 1, turtle soup, and then attack the 50% of this one specific candle and the opposing end of the range. What makes ICT, the concepts, and what makes the concepts I present special is dealing with specific candles. Every other system, supply and demand, Wyckoff, market structure, all that nonsense, all that garbage is trading zones. You can do that, but it's more accurate and more consistent even to look at specific candles and what's happening. Same over here, by the way. This candle, turtle souped, and then you target the high of the candle. This candle over here, turtle souped, and then you target the 50% first. Range trading rules say take off a partial at the 50% at all times. Now, we didn't close above this one, but we closed above this one. Therefore, there's a conflict of interest, and you look for a turtle soup because close above equals higher prices. Now, that was a mouthful and a mindful, so watch it once, twice, 3 times, because this right here, what you see, is the key to the markets. One of the most crucial elements that exist. So use it well and study it well in private 1,000 times. See how it works, and then come forward to show it to the world. I hope you found that insightful, and I wish you good luck, good trading, and see you in the next video.